Welcome back. We have Brian and Boone here again on the show. And this week, we're going to talk about why are RIAs and independent advisors moving towards private real estate and some alternatives. I know we've talked about diversification and what true diversification looks like. And so we're going to move into really where some of those RIAs are looking at new opportunities and things like that. And so Brian and I were just discussing some unique approaches and what traditional equities advisors and financial advisors do versus what some of the I'll say stronger advisors or advisors that are working with higher net worth individuals and how they're allocating their portfolios. And so, as I've said, I've got Boone Lasater, our co-founder and CFO, on here. I've also got Brian Robb on as well as myself. And so, Brian, I know as I'm sure you have had this question a lot. I know I have here recently, or this position that a lot of the people that we talk to are still in a traditional 60/40 portfolio in their stock portfolio or their investment portfolio as a whole. I'll call it a stock portfolio because that's what it's pretty well primarily broken down to. So maybe explain quickly for us what the 60/40 model is for those of us that may not know what that is. And then we're going to start moving into the new model that the high net worth and the extremely wealthy have used for years that is now being utilized in more traditional portfolios. So maybe let's start with what the 60/40 portfolio is.
Yeah, thanks, Ty and Boone. Good to be here again. You hear this a lot. The 60/40 portfolio is kind of a way for advisors and investors to identify what's the right mix of asset class. And so your traditional 60/40 portfolio is 60% equities, 40%. I'm going to put this in a broad category of fixed income, but traditionally bond instruments. And that could be treasuries, that could be corporate bonds, number of different types of fixed income instruments. That number is going to change over time. So as you get closer to retirement, typically your risk profile increases, and the historical kind of advice is going to be have a larger percentage of equities when you're further away from retirement. So a good example would be if you've got an investor in their 20s or 30s, that might be a 90-10 portfolio. You should be focused on having a larger allocation into equities, smaller allocation into bonds. As you near retirement, that those numbers are going to shift, right? So middle age, 15, 20 years away from retirement, you typically hear a 60/40, 60% into equities, 40% into some sort of bond or fixed income allocation is probably appropriate. And then as you get into retirement, that number is going to increase as far as your allocation towards bonds. It should be 50/50, maybe 60/40 the other way. 40% into equities, 60% into bonds once you're at retirement. As we all know, when you retire, that's not the end. You're going to hopefully live, another 10, 20, 30, 40 years. The statistics are a little different if you're married, right? If you're a married couple and both of you are at age 70, the statistics show there is a good chance one of you is at least going to live another 30 years. So those numbers may change a little based on who you're working with and as an advisor. But think of kind of middle age, 60/40 is a good split. As you get into your 70s or 80s, that's probably more like 80% bonds, 20% equity. So that's going to vary just a little bit in the marketplace.
So Brian is not only our managing director here at Laster Capital, but you've got a 25 plus year career in the equities market. I know you've got a number of different financial licenses. You've worked in all aspects of financial management from the public equities, public markets to private markets. You've managed teams. So explain a little bit what you've seen when working with higher net worth individuals and the more shift in what we're seeing today in a 50/30/20 model. What is obviously the 50/30 still pertains to equities and some sort of cash flow mechanism, whether it's a bond, a CD, whatever the case may be. But you've got 50/30, and what's that 20? Let's break down the 20 model.
Yeah, so the 20 is alternatives, right? So 50 equities, 30 bonds, 20 alternatives. And what I mentioned earlier falls true as well. Depending on your age and your risk tolerance, those numbers are going to vary a little bit. So, it might be a higher percentage in alternatives because of the benefits they offer if you've got a longer time to retirement. But for argument's sake, let's just say your traditional 60-40 portfolio really now is looking more like that 50-30-20. So 50 equities, 30 fixed income bonds, and 20% alternatives. And what you'll find with most advisors, now keep in mind, they're going to work with either an RIA or a broker dealer that they will have some models and some recommendations on what ultimately those numbers should look like. But generally, it's about 20% into some sort of alternative exposure. So let's further break down that 20%. Out of that 20%, typically around 10% is going to be allocated into real estate, not 10% of the 20, 10% of the entire portfolio. So about 10% of your portfolio should be allocated towards some sort of real estate, the other 10% into other types of alternatives. And as we all know, there's a number of different alternative type investments. You can buy oil and gas, you can do credit funds, but typically about a 20% total allocation, with half of that allocation being dedicated towards real estate.
You brought up age, you brought up kind of demographic and where you are in life. I know for me specifically, I'm 25, 5 and 70
Yep.
is probably my allocation. That 70 is a majority of that's going to be real estate. And then as it pertains to alternative, there's a number of them. There's debt funds, which I've been involved in. You've got traditional private equity, which I've got some of. So, and then we've got Boone on here. Boone's another young entrepreneur and investor. So Boone, what do you see? What does your model look like? And why are you allocated the way that you are?
Yeah, I'm going to be Ty a lot more similar to you. Obviously, when I'm looking at investments, I'm going to look at, what's my goal with whatever investment I'm putting it in. There's typically kind of four different things that I look at. A you know what am I going to see from a growth perspective? What am I going to see from an income perspective? What am I going to see from a preservation of my capital? And what am I going to see from a tax planning perspective? So I'm going to take each of those four things, break it down. Equities markets, you're going to tend to see your growth and your income. The bond market, as Brian talked to, you're typically going to see your that's where your preservation's at. And then your alternatives is where you're going to see growth, income, and tax advantages from. And I take a look at, each four of those different components as I go into an investment. I weigh it against my, risk factors across where I'm at with my current investment strategy, and that's kind of how I decide what I go into. Right now, I'm definitely weighted higher on I'm wanting to mitigate taxes and I'm wanting to, gain growth in my portfolio.
So I think there's a lot that goes into that third category, the alternatives. And oftentimes what we see, and in most cases, those investments are set aside for the extremely high net worth individual, or what the SEC calls an accredited investor. You're going to ask, what is an accredited investor? Well, an accredited investor is essentially somebody that you qualify one of two ways. The first way is you have $1 million net worth. Now that excludes your personal residence. So you have a 401k plan. Maybe you've got some gold. You've got your bank account, your checking account, and your savings account. You have a second home
Retirement
that is,
accounts.
yeah, all retirement accounts. You've got a second home that's worth 500,000. You got a $200,000 loan on it, so there's another $300,000. It's everything excluding your current home, assets minus any liabilities that you may have against it. So if you have a piece of property that's the asset, that liability is going to be subtracted from that. That's one way. The other way is the income category, and if you're an individual, that's $200,000 a year, and you've done that for the last 2 years. If you're married filing jointly, that's $300,000 combined. over the last 2 years, and you reasonably expect the same for the coming year. And then there's a couple of other ways if you have your financial licenses or other things like that. We're not going to get into that, but really, as it pertains to those alternative investments, there's three rings of I guess I'll call it three levels of the investor ladder that you can really look at. And each ring gets a little bit more opportunistic. You start with you're not accredited and you're not liquid. Well, at that point, you really have one option, and that is to have a side hustle. Maybe you're going to build up a little bit of liquidity and you're going to buy an investment property yourself, or you're going to invest in a business and have a second source of income on the side. And that is really, really limited to the opportunities, and it's going to boil down to your sweat equity that you put into whatever efforts that it is that you're going to do. And that's kind of how Boone and I got started 20 years ago. The second level is you're not accredited, but you have some liquidity. And there's some opportunities that lay in that avenue that are available to that individual that are not for just accredited investors. And that typically comes in the form of a Reg A fund. Those are going to be a little bit lower overall upside. You're going to have lower minimum requirements to an investment, but you're going to have a capital lockup period. Then you step up to accredited investor. With the accredited investor, it really opens up to your opportunities there, and there's a lot more opportunities. And then from there, you've got a qualified purchaser. That's somebody that's, Brian, correct me, I think it's $5 million or more of investable capital, and it really opens up at that point. But that alone, and talking about those levels of investing is really can be an episode of its own. So we'll get back into that at some point. But what we have seen in the past is we haven't had a model for investors, or that financial advisors really utilized to allocate capital into those alternatives. And that's what we're seeing more focus on now. What we've seen is, your traditional advisors, Brian, you mentioned they use a 9-box. What is that 9-box for those of us that don't understand?
Yeah, so the 9-box was coined by Morningstar. Morningstar is used by a lot of advisors. I look at Morningstar. It's a good resource for investments and stocks and mutual funds overall. But typically, Morningstar kind of coined this 9-box concept, and it's a way to look at an individual's center of gravity on their overall portfolio. And so, if you imagine the 9 boxes, you've got 3 rows going from left to right, 3 rows going from top to bottom. And if you look at the top row, those are going to be your large cap funds. So think of buying Coca-Cola or General Motors or 3M. Those are kind of your large cap stocks. The next row are mid cap companies, just like it sounds, medium capitalization type companies. The bottom row are small cap companies. So smaller companies that have a certain amount of overall capitalization and revenue. And your risk obviously increases as you go from large cap to small cap. And then from left to right, you're looking at value add type stocks. Blended stocks are kind of in the middle, and then growth stocks on the right. And so when you look at a portfolio, and a lot of advisors will have tools that basically you can plug in all of an investor's assets, and it'll grid out kind of where you fall in that style box. It provides some direction on maybe you're too highly concentrated in small caps. You need to allocate a little bit more to mid caps or large caps. Return potential on small caps are a little higher, but the risk is higher, right? And how much of that should you have in value-oriented stocks versus growth-oriented stocks? There's a 9-box for fixed income as well. And so the way that works is it basically from top to bottom looks at high quality, mid quality, and then lower quality. Consider those junk bonds. And then from left to right, we look at duration, short duration, medium duration, high duration. And so you can do the same thing there. You can grid out where an investor may fall in that traditional 60-40 portfolio on where do you fall in the 9-box on equities, where do you fall in the 9-box on fixed income. But interesting, there's something that's missing in that 9-box, and that's access to alternative type investments. And so we'll talk a little bit about this, Ty, but it plays into kind of the family office strategy and how they look at the traditional nine box, which is very different than what you might find for a typical investor in the marketplace.
Well, yeah, you're going to take a family office and they're going to be much heavier focused on capital markets, whether that's, you're going to see they're probably a 40-10-50 model. They're going to have 40 in equities, 10 in what Boone called preservations, and probably 50 in alternatives. Now, those alternatives are going to be heavily split. They're going to have probably half of that in real estate, and then the other half is going to be in private equity, in debt instruments, and things like that. And that's where we've really seen a big opportunity, if you will, for the individual high net worth person. But that person has also missed out on a lot of opportunities. And so for a company like us, it creates an awesome opportunity in our market. But for the individuals that we're targeting and going after, they really, what they don't know has been their biggest weakness in their financial portfolio and their ability to grow their net worth. And that's really what we're focusing on here, is bringing an aspect of real estate investing to the individual who has set at a very successful white collar career for the majority of their life, and missed out maybe on some opportunities that have really been set aside for the extremely high net worth. And if you go back years, back to probably when my grandfather was a blue collar worker, and pension funds were a much bigger focus. And now you've got, it's mostly all 401ks. But when pension funds were a focus, they had allocations into alternative investments and private investments. And we now have seen an executive order from the Trump administration that is bringing alternative investments to the 401k platform. So maybe walk us through the opportunities there. Boone, I want to start with you and what those opportunities look like. And then Brian, I want to hear your input here.
Yeah. So it's very interesting. Trump is very heavily in real estate, and a lot of times you see Washington move in the way that they want their money to move, and so a lot of tax reform and a lot of tax law comes from what are the investments that the people on Washington Hill are making. The other thing that Trump's doing is bringing back the bonus depreciation and those sort of things as part of the big beautiful bill. So one of the big things that we like to do, we like to help our clients do is, Ty, you talked about the people that are in those white collar jobs that they go through a career of work making extreme amounts of money. But they immediately lose a large portion of it to to the IRS. And so, part of what we do is, work with phenomenal CPAs that help clients, recapture some of that money on their 1040s. That's part of what proper tax planning does is, how do I get to mitigate, my taxes? How do I get to, every dollar you save on your 1040 allows, for just that much more compounded growth in your overall portfolio. And, so I know I kind of got off topic there and we were talking about the 401k platform, but I think it's just as important to look at tax strategies as it is retirement strategies. Both are forms of accelerating your wealth, and the being able to now invest in private equities from your 401k. Typically, you've had to transfer your money into a self-directed IRA account. It takes, a lot of work with a custodian and everything else. And so I think it's going to make it that much easier for people to invest those retirement accounts into the private sector.
So Brian, why do you think, what is it that drove the Trump administration to open up private investments to the 401k platform? On the one hand, you've got traditional advisors and maybe your more mainstream advisors, your, Fidelity or your Edward Jones, Merrill Lynch, whatever the case may be. your traditional advisors and they say, well, these alternatives have a lot more risk with them. But you've got the Trump administration, who, first of all, Trump has built his wealth in alternative investments. But secondly, they're looking at a focus and really executed an executive order to bring these alternative investments to mainstream so that 401k, the individual investor through their 401k has access to these types of investments. Why do you think that is?
Yeah, you mentioned it earlier, Ty. It's kind of ironic that, if you had a parent that was a blue collar worker in the 60s or 70s, and let's just say they were working on the assembly line at General Motors, and they participated in the pension plan, which most of them did, they had access to alternative investments because those pension plans, they're going to invest for a certain targeted return rate, right? And they're going to manage risk reward, obviously, but they had access to alternative investments as a blue collar worker. If you are a very sophisticated investor today, maybe you're a partner in a law firm, an IT specialist, a orthopedic surgeon that participates in your practice's 401k plan, there's a good chance you actually don't have access to alternatives. And you're coded typically as a more sophisticated investor. So, there were some ironies going on there. And I think that was one of the things that really pressed the need to start to address this. The other thing that I think we have to look at is there's continued focus on what do we do with the Social Security system and the shortfall there, right? That's a big hot button item that no politician wants to touch. But there are ways, and at least the administration is starting to address that, even if it's on the periphery, on the outside. And one of the ways to do that is to democratize the investments into alternatives, like you just mentioned earlier. So in August, an executive order was signed that allowed for alternative investments within 401k plans. As you can imagine, there was a lot of debate on both sides of the aisle on the benefits and the drawbacks potentially of that. I'll let you kind of draw your own conclusions on where we feel like the advantages lie in that. But at the end of the day, if your blue collar parent had access to alternative investments, why don't you have access to those same type of investments? And opening it up just makes sense for the very reasons that we talked about earlier. So you look at some of the largest providers in the country. Power, I think, is the second biggest 401k record keeper in the country. They were one of the first to come out of the gates earlier this year and actually state that they are going to be offering alternative investments for their participants. And so this falls a little bit to your point earlier about the levels of accredited investors. You've got accredited, you've got qualified purchasers, and you have large investment funds and pension funds, and making alternatives available to those funds, which investors in 401ks now have access to. What we've got to do is kind of wait for the market to catch up, right? So it's there, it's available. There are certain protections in place. There's something called a best interest contract provision, which falls under the Securities Act of 1934. And essentially that it's just like it sounds. It means if you were an advisor, you have to act in the best interest of your participants. So the other thing to really look at is almost all fee-based fiduciary advisors, if they act in a fiduciary capacity, abide by the best interest contact provision, and almost all fiduciary advisors offer some sort of alternative investments. So that's not a coincidence. So you've got kind of this conflux of events happening where you've got the big provisions that mean more and more of these advisors, as acting as fiduciaries, are offering alternatives. And then at the flip side, the largest savings vehicle for a majority of Americans, the defined contribution marketplace, now has opened up access to alternative investments for all the reasons you just mentioned earlier.
Well, you bring up some good points, and I think another thing that I have found is advisors look at alternatives, and with alternatives, like, we label our fee right up front. We say, okay, this, we're going to take a 1 or a 2% asset management fee. We label that right up front, but then they look at other aspects of a alternative investment, and they say, well, these are these high fee investment vehicles, and yeah, you may make a larger return, but the manager is making all the money, and that's actually not the case. I know specifically with ours, like, we take an acquisition fee on an asset when we acquire an asset, but that comes from the asset itself. It does not come from the investor. So when an investor invests Let's say we have a new investor that comes in and invests $1 million into one of our funds. We're taking a asset management fee off of their capital, and that is all that comes off of their capital, no different than anything in the equities market anywhere else. The acquisition fee comes from the asset. But if you look in the equities market, one thing that advisors typically don't talk about is the fee structure throughout a investment, whatever it may be, whether it's a stock in Apple or it's a mutual fund, specifically with mutual funds, because you're going to start with the firm that structures the mutual fund is going to take their fee, the broker dealer is going to have their fee, the financial advisor is going to have their fee, and it's fee multiple times throughout. And it's really no different than the private alternative investments. But I think what I have found is that most of the time, advisors just don't understand the structure. And so now you talked about the best interest contract provision, but at the end of the day, I think advisors are oftentimes looking at what is the least risk that I can do without having to put forth any effort to underwrite an opportunity or do due diligence on an opportunity. And then what you're stuck with is a client or an investor who has been told that they've got a diversified 401(k) plan because they're in multiple different asset classes in the equities market, but they don't have different investment vehicles. So they're not truly diversified. They're all 100% correlated to the market. So
Yep.
how would you explain to an advisor, how are you going to walk an advisor through and from being one yourself, the different fee structures and how you would underwrite two different opportunities, one being maybe a mutual fund and one being an alternative asset fund?
Yeah, I mean, it's really apples to oranges if you look at it. I mean, your traditional mutual fund, you just mentioned it, Ty, you're going to have an asset management fee. There's embedded fees like 12b1 fees, which go to pay marketing expenses. Your advisor may have a fee, probably does. They have to manage the assets, and so portion of that goes to pay them. Whether they do good or bad, that fee gets paid, right? So in the old days, you had commission-based fees, which it was kind of the transaction-based fee, right? You trade a stock and it generates a commission and they get paid kind of once. That still happens, but the more popular method is kind of an asset-based fee. So you're paying an advisor to manage your portfolio, and whether the portfolio goes up or down, they're getting paid the same amount of fees. But they're kind of correlating that structure with real estate. Now, if you went out and purchased a piece of real estate individually, you mentioned an acquisition fee. Like, how does that apply? It's not a fee embedded in the overall cost of the investment, right? That might be a one-time fee. Or if there's construction that's needed on a property, that might be a one-time fee, and how that gets paid is very different. I think the important differential to look at is the incentive structure. And the incentive structure with most of the kind of direct private placements really incentivize operators and general partners to really win only if there's positive success in the portfolio. And so, this could be a whole nother episode about how the waterfall structure works on these funds, but ultimately, our incentive is to make sure that we perform and we do a good job growing the value of the properties and ultimately pass that on to our investors. Otherwise, we don't really win. If you compare that with a traditional mutual fund investment, again, they're going to get paid the fees regardless. And so it is a little bit apples to apples. We could write a whole dissertation on the differences between the two. But as an advisor, what I would say is you have to be careful hyper focusing on the fee structure and ultimately look at net returns. And Boone made a great point, because the one thing that you get in real estate that you don't get with taxable type accounts, so IRAs, annuities, a little bit different, are significant tax benefits. And so you have to look at net return after any fees have been paid, but you also have to look, as we talked about in an earlier episode, net return after behavioral financial decisions and net return after taxes. That can be very different. If you look, again, I'll pick on Morningstar. If you look at Morningstar and you just pick a mutual fund and say it's returned X percent, 10% over the past 10 years, that's not necessarily what your return was, right? Your return would be very different when you factor in those things and your actual net return. So it's important to understand the differences and really look at the apples to oranges and conflate that in a way that makes sure that you're really comparing it in a way that's advantageous for your client. Also looking at the counter correlation portion of that, which is
I
another
think,
another
Brian, you
topic.
brought up a good point that I want to end it on. And when you're focused and when you're looking at value investing, value-based investing, it's really what is the incentivization, not what is the fee structure. You're not going to save your way to a mega millionaire. You're going to have to make some decisions, some offensive decisions to, build your portfolio to accomplish what it is that you're trying to accomplish. And so you want to look at those incentivizations. And so, when you really break it down, on the one hand, you've got an equities market that somebody's going to get paid no matter how it performs. And I had a really good call yesterday. I had about an hour long conversation with one of our clients, one of our really good clients, that I'm not going to mention his name. He's a household name, very well known individual, but had a conversation with him, and we were talking about the incentivization. And he had a conversation with a couple of our other clients, and they were wondering what was going on because we weren't having distributions going on right now. We've had some capital calls in some of our funds, and they associate that with a problem, whereas it's actually quite contrary. With private investments, it's capitalism at its finest. We are focused as an operator, as a manager of the fund, on doing everything we can to get that business model, to get that asset to executing at the highest level possible, because we are incentivized to do so. If we have an asset, if we have a property that just fails all the way around. It doesn't distribute cash flow. It loses value. We didn't have any equity in the get-go, and we run out of tax advantages. Well, we're going to lose money, and we're not ever going to make a profit of any kind. So I'm not going to make a living. I'm incentivized to make sure the property exits at the best exit possible. And in getting there, there may be a period where we don't have cash flow because we're putting cash back into the asset, because by doing so, it's pushing the value so that we can meet our exit thesis. And so these alternative investments, what you've got to understand is there's typically a capital lockup period. Most of them are, I've seen them as long as 10 to 15 years. Most of ours are 5 years. So you've got anywhere from 5, 10, 15-year capital commitments. But that is a time period that is focused around taking an asset that's underperforming, getting it to performing, and then taking it to market and exiting it. And so what happens at year 3 inside of a 5-year investment is small compared to the overall focus of the asset itself, whether that is a small business that's been purchased, whether that is a commercial real estate property, a multifamily real estate property, whatever the case may be. If there's a period of 2 years, 1 year, 3 years where something goes different than what was expected on the front end, that's because the operator is executing to meet that exit on the back end. And that is why the extremely high net worth have always allocated capital into these alternative investment vehicles, because they do what, Boone? You mentioned this earlier. They check what boxes?
So, I'm sorry, which piece?
On what are those boxes that an alternative investment checks?
So typically an alternative is going to check both your growth, your income, and tax advantages. I mean, there's, out of the four pieces I look at of an investment, it really can check all four. I mean, it can check preservation as well, but it's really going to take care of your growth, income, and tax advantages.
And that's really what we're focusing on here. You've got, I refer to it as the four keys to wealth as it pertains to investments. And so you want to be able to check 2 to 3 of those boxes as you're involved in private alternative investments. And sometimes cash flow may fall off. Sometimes growth may fall off a little bit, but you're typically going to get 3 of the 4 that help deliver a better overall return profile. So, with that being said, Brian, you have anything to finish on here with what we've talked about there with alternatives?
No, I think it was a great episode. A lot more to come as it relates to the broader equity markets and We can talk about counter-correlated assets and specifically bonds, but a lot coming in the future. So
Well, so I appreciate that. Thanks y'all for being here this week. And next week, I think we'll probably dive into an accredited investor and how you really work through those rings of that ladder and what each ring looks like and the opportunities that you have at each level. So thanks for being with us again this week. And go have a wonderful rest of your week. I look forward to following up with any of you. If you have any questions, comments, definitely type in your questions in the comment box and we will return those answers just as soon as possible. So thanks for everybody being with us this week.
Have a great Christmas, everyone.
thank you, everyone.